Welcome to the deep dive. Today, we are cutting straight through the noise. Past all those sensational headlines.
Yeah, the ones bouncing between imminent collapse and some kind of unprecedented prosperity.
Exactly. So, if you're looking for a clear, balanced view of the economy, one that actually respects the complexity of the data, this is your deep dive.
It's absolutely critical right now. We have to maintain objectivity because we know those narratives out there. They tend towards extremes,
Mm-hmm.
driven by cliques, maybe political affiliation.
Mm-hmm.
So our mission today is really to anchor ourselves in objective context. We're focusing on the structural forces, things like fiscal dominance that are, fundamentally redefining things.
Like recession risks.
Recession risks, the interest rate outlook, future asset performance,
Yeah.
the big picture stuff.
Right. So, our mission is clear. Unpack the sources, provide a balanced outlook. We'll get into why maybe traditional recessions are less likely now,
Hmm.
how the central bank might be, forced to act, what this all means for things like your mortgage rate.
Which is on everyone's mind.
Definitely. And crucially, where you, the listener, should maybe focus energy and capital in what feels like a high-pressure environment. Okay, let's jump in. The central structural force you mentioned, fiscal dominance. This isn't just a temporary thing, is it? You're saying this is more like a permanent state the economy's entered.
That's the argument, yeah. Fiscal dominance essentially means the government spending and, its debt needs, they now override the central bank's ability to conduct independent monetary policy.
And the evidence for that?
It's pretty startling, actually. The structural deficit is running at, 6 to 7% of GDP?
Wow.
And crucially, that's without the economy being in some major recessionary crisis. That huge continuous deficit spending, it acts like a perpetual stimulus. It's just embedded now.
And structural means locked in, not just like one-off stimulus checks we saw before.
Exactly. You're talking entitlements, Social Security, Medicare. Then there's the interest expense on the debt itself, which is climbing fast.
And defense spending.
And defense spending. These are big ongoing commitments. They keep overall economic activity kind of artificially elevated, even if the private sector is feeling sluggish.
Which explains that sort of K-shaped feel people talk about.
Right.
Or two-speed economy.
Precisely. That's the engine behind it. If you look closely, you see plenty of softness. Private sector manufacturing, struggling. Commercial real estate, definitely wobbly.
Housing volume has basically stalled.
Right. Transaction volume has ground to a halt.
Yeah.
And yet the headline GDP, the overall labor numbers, they stay surprisingly robust. Why? Solely sustained by that huge, immovable government spending.
So this really changes how we should think about risk in the U.S. economy. We're used to recessions, meaning, sharp pain, high unemployment, falling prices, disinflation.
Yeah.
You're suggesting that model might be obsolete.
Sure. Well, maybe not obsolete, but far less likely.
Yeah.
Those traditional developed market recessions where the pain is mostly job losses, they might get replaced by something that looks more like an emerging market style recession.
Okay, what does that look like?
Think back to 2022. Remember the misery index? That's just unemployment plus inflation.
Right.
It hit levels you normally see in a deep downturn. But the misery wasn't really coming from mass joblessness. It was overwhelmingly driven by high inflation.
So people felt the pain, the economic heat, but the job market didn't completely break like in, say, 2008 or the early 80s.
Exactly right. And that's the key structural difference now. That fiscal support system, because it's so large and reactive, it actually sort of preemptively widens as soon as cracks appear in the private sector.
So it cushions the blow.
It cushions the unemployment blow, yes.
Mhm.
You might see a softening labor market, sure. But the inflation part, it probably stays flat or maybe even ticks up a bit because of that continuous spending. You don't get that sharp disinflationary drop you'd normally expect to sort of clear the system.
It sounds like the government is both the source of the inflation problem and the mechanism preventing the traditional disinflationary solution.
That's the squeeze. That's exactly the bind we're in.
Okay, so this is where we need to talk about the central bank's role, the Fed. Given this fiscal dominance, a lot of people are just waiting for the big print, right? Like a sudden flood of QE like 2020.
Yeah, that's the expectation for many.
But your base case is different, more subtle, more gradual.
My base case is absolutely a slow, managed, gradual shift. They will begin increasing the Fed balance sheet again eventually, but they'll likely go to great lengths not to call it quantitative easing, at least not at first.
So how will they frame it?
Probably as, necessary financial plumbing repairs, fixing leaks in the system.
Okay, and to understand this gradual path, you point back to something most people have forgotten, The September 2019 repo spike. Why is that a good analogy?
Because that event was a flashing red light for system liquidity. Let's just break down the mechanics simply. The repo market. It's where banks lend cash to each other overnight.
Usually against treasuries as collateral.
Right. Keeps the whole financial system running smoothly day to day. But in 2019, you had this collision course. The government was issuing tons of debt-widening deficits, which soaked up cash. At the same time, the Fed was doing quantitative tightening QT, shrinking its balance sheet, actively sucking cash out of the banking system.
So government needs cash. Fed is removing cash. Not good.
Exactly. A liquidity leak. Cash reserves in the banking system got dangerously low. And that overnight lending market, the repo market, it just seized up. Rates spiked wildly.
I remember that. Chaos for a few days.
Total chaos. The Fed had to step in immediately. But importantly, it wasn't QE to stimulate the economy. They bought T-bills, short-term stuff, just to refill the cash reservoir, put out that plumbing fire.
So they learned from that. They have tools ready now.
They have standing facilities now, yes, they learned. But the underlying pressure, the deficits, that remains. And interestingly, the New York Fed has been sort of telegraphing that they expect to start increasing the balance sheet again around 2026.
2026? It's not that far away, really.
No. And the idea seems to be expanding it roughly in line with GDP growth. So the balance sheet as a percentage of GDP stays kind of level, but the nominal amount, the dollar amount, goes up year after year.
Okay, but here's the rub. If the Fed's main tool for fighting inflation, raising rates, actually worsens the fiscal deficit by making government borrowing more expensive.
Yeah, raises the interest bill.
How can they ever really fight this fiscal-driven inflation effectively? It seems like an impossible situation.
It is an impossible dilemma.
Yeah.
And the market knows this. The market is fully aware that no matter how tough the Fed talks, no matter how committed they say they are to 2% inflation, ultimately they are constrained. They have to ensure the U.S. government can fund itself, and they have to prevent core financial markets from breaking. If a serious liquidity leak springs up sovereign bonds, regional banks like last year,
They have to step in instantly.
to prevent catastrophic failure. That necessity dictates policy. It severely limits their ability to wage an aggressive war on inflation when the inflation is coming straight from the government's wallet.
Okay, so let's bring this right down to brass tacks for, the average person listening. What does this whole environment mean if you're waiting for mortgage relief or hoping to buy a house?
Well, look, the unfortunate reality we probably have to face is we've likely seen the generational low in mortgage rates.
You mean those 3-4% rates?
Yeah, that range is, well, mathematically, it's just very unlikely to return when you have this fiscal dominance, this structural inflation risk baked in. Maybe 5% is achievable down the road. But 4%? That's a real stretch.
And people often assume, oh, when the Fed cuts the short-term Fed funds rate, mortgage rates will just follow. But that's not always true, is it?
Not at all. That's the inflation premium kicking in. Sometimes the long end of the curve, the 10-year, the 30-year Treasury yield that drives mortgages, it goes sideways or even up when the Fed cuts.
Why would that happen?
Because the market might read it as the Fed being forced to cut, maybe because something's breaking or because they're giving up on fighting inflation.
So it signals a loss of confidence in their inflation-fighting resolve?
Exactly. And bond investors then demand a higher premium for that inflation risk going forward.
Okay, so for the national housing market overall, you're not predicting a 2008-style crash, more like a sideways correction.
That's the base case, yeah. A correction through time, not a sudden price collapse.
But how does the market fix that huge gap that opened up between home prices and average wages? That seems unsustainable.
It corrects through time. Think about it. The hurdle for a really sharp disinflationary bust is just incredibly high when the government is pumping 6% of GDP into the economy every year as stimulus.
Too much support.
So instead, prices might just go sideways or maybe drift down only marginally. But they do that for, say, 3 years, 5 years, maybe even 7 years.
And meanwhile?
Meanwhile, nominal wages keep rising because of that background inflation. So wages gradually catch up to those elevated house prices. They meet in the middle, the market rebalances, but through patience, not pain.
That sideways scenario has huge implications, though, especially for the consumer economy, because it means we probably won't get that big refinancing wave, that free lunch people got used to in past Fed cutting cycles.
Precisely. That's a key point. If we don't hit a new, dramatically lower floor for interest rates, the pool of people who can actually benefit from refinancing becomes tiny.
It's only people who bought very recently at the highest rates.
Exactly, which is a relatively low volume of borrowers compared to past cycles. So you end up with a very weak refinancing cycle,
Yeah.
less cash freed up for people to spend on other things.
And that keeps the brakes on the consumption economy.
It prolongs the malaise, yeah. It helps keep that two-speed reality going for longer than people might expect based on typical recovery cycles.
Okay, so given all these sort of structural constraints, the slow-moving nature of fixing fiscal issues,
Mhm.
where should individuals focus if the cavalry isn't coming soon on the fiscal side?
Right, not in any investable time horizon.
The responsibility really shifts back to personal financial resilience, doesn't it?
Absolutely. The focus has to be on acquiring hard, scarce assets, things that can hold value in this kind of environment.
What does that mean for you personally? Where do you see value?
Well, in terms of my own holdings, I favor equities. I hold gold and I hold Bitcoin. And, personally, I view Bitcoin as potentially the fastest horse in the race for long-term performance, mainly due to its fixed supply and its growing role in the digital world.
Let's dig into that asset rotation a bit. Gold has had a strong run lately. It often acts as that traditional hedge against currency issues. But you think Bitcoin might outperform near term?
I do, yeah.
Yeah.
Right now, gold is showing some signs of being maybe sentimentally overbought. Its fundamental case is still solid, obviously, as a hedge against central bank actions.
Mm-hmm.
But gold is also just a massive asset class, right?
Yeah.
About 10 times the size of Bitcoin, market cap-wise. So over the next, say, 6 to 12 months, my bet would be on Bitcoin to outperform gold.
And that's assuming what?
Assuming we get through a necessary washout of some of the speculative froth first.
Yeah.
Particularly in the riskier altcoin space, maybe some of those treasury-backed token things, get that cleaned up.
Mm-hmm.
It lays the groundwork for a more focused rally in the core asset.
Okay, now we have to talk about the big elephant, the U.S. debt itself. We're seeing this incredibly rapid growth in stablecoins. You called them a modern eurodollar. They could hit $1 trillion in assets under management soon.
It's possible, yeah.
And the issuers are making bank, right? Taking dollar deposits, sticking them in short-term treasuries, yielding 4-5%.
Highly profitable business model, yes.
Is this explosive growth a potential savior for U.S. debt demand? Could stablecoins absorb all the new treasuries being issued?
It's definitely a fascinating development, and yes, very profitable for the issuers, but I have downplayed the idea that stablecoins are the ultimate savior for U.S. debt. Look at the numbers.
Okay.
They might generate billions, maybe even 100 billion, maybe a couple hundred billion in new treasury demand eventually. That sounds like a lot.
It does.
But it's still only a small fraction of the $2 trillion in new deficits, new treasury supply we're facing each year.
$2 trillion a year. Yeah. Okay. Puts it in perspective.
It's a helpful variable on the demand side, for sure, but it doesn't fundamentally solve the structural supply problem.
Now, you mentioned something really intriguing earlier, a specific kind of obscure mechanism the government actually has on the books to create liquidity and spend without issuing new debt, repricing gold.
Yeah, it sounds like financial wizardry, but it's real.
Yeah.
It's written into the Fed's operating procedures based on historical precedent.
How does it work?
Well, historically, the Fed carries the gold. It holds on its balance sheet at this ancient price from the 1970s, like $42 an ounce or something.
Which is way below the market price today.
Massively below.
Yeah.
So if they simply revalue that gold on their books to the current market price, say $2,400 an ounce or whatever it is, that act instantly creates a huge credit on the asset side of their balance sheet. And they could then credit that amount to the Treasury General account, the TGA, the government's checking account.
So the government suddenly has more money to spend.
Without having to go to the bond market and borrow it by issuing new treasury debt. They don't need to borrow from you or me or China.
That sounds almost like a free lunch. But what's the catch? What's the real-world consequence?
It's effectively a form of purchasing power default. The government is officially acknowledging on its own books that the dollar is worth much, much less relative to gold than it previously claimed.
Devaluing the dollar against gold.
Exactly. Now, the immediate impact, extremely pro-liquidity. Probably huge for asset prices initially, but there's a massive historical warning sign.
Which is?
When this kind of devaluation was used in the past, think around World War II, it absolutely had to be paired with serious fiscal austerity right afterwards. Spending cuts, tax hikes, getting the budget under control.
To establish a new, sustainable baseline?
Precisely. If they just do the gold revaluation trick without fixing the underlying ongoing spending deficit, well, then you just accelerate the drift towards that less disciplined, unstable, emerging market style dynamic. It could backfire badly long term. So yeah, the final takeaway here, it's hard mode economics right now. It really is. A structurally difficult environment.
Hmm.
But the key is to focus intensely on what you as an individual can actually control.
And given how complex and frankly, maybe overwhelming some of these systemic problems sound, what's your best advice for listeners trying to maintain focus? How do you avoid just falling into information paralysis or despair?
Yeah, that's a real risk, I'd say. Avoid the perpetually online trap. Scrolling endlessly through takes that just feed despair loops or anger loops, it's not productive.
So what's the alternative?
Cultivate what I call radical context. When you see some shocking statistic or headline, always check it against the data from 5 years ago, 10 years ago, 20 years ago. Get the trajectory. Understand the real meaning.
Ground yourself in the longer view.
Exactly. And recognize that while these systemic problems are huge, the most effective thing you can probably do is focus on making small, tangible, local improvements. In your own life, your own finances, your own community. That's the path forward.
Okay, so this deep dive has really highlighted these gradual, powerful structural forces, especially fiscal dominance, the need for personal financial resilience, probably through scarce assets, and this potential asset rotation favoring hard scarcity over cash or maybe even traditional bonds. The future seems defined less by a single crash and more by the slow, relentless widening of that fiscal gap.
I think that's a good summary.
So we'll leave you, the listener, with this provocative thought to chew on. If repricing gold really is the only existing on-the-books method for the government to create massive liquidity without issuing new debt like a hidden emergency button, what happens to confidence in the dollar? What happens to its purchasing power in your wallet when the government officially admits via its own accounting that the dollar is worth, say, 99% less against gold than they were claiming just the day before? How might that shock ripple through the social and financial fabric, especially one that already feels pretty stressed, something to mull over as you navigate the economy ahead?